We are going to start with the stock market. In case you haven't seen the numbers yet, it's not very good news. Every single index today closed down big.
Yeah, don't peek at those 401ks. The losses for all three indices around 2%. I just checked, and at close, the NASDAQ was down over 3%. Not significant losses, but enough that it gets our attention. And those losses, by the way, erode much of the gains that we've seen over the past couple of weeks or whatever it is. So not a great time for the markets and for our 401ks.
So we invited a friend in, Elizabeth Scheider with Sequoia Financial Group, joins us now here on the What's New set. Elizabeth, help us on this. What happened today?
Yeah, well, so the market's digesting three real pieces of information. Yesterday, we raised interest rates here in the U.S.
Right.
And then today, across the pond in Europe and in England, they raise interest rates too. So this global economy is trying to slow down. And then the third piece is we had retail sales come in for November below expectations, which means we're not spending as much as the market thought we would be.
I always thought that was the purpose for interest rate hikes. I mean, we were spending too much. They want us to control spending. And this hike was only 50 basis. It was a half a percentage point, essentially. But we've had 7 this year, and the indication is from the Fed yesterday, we're going to have more of those next year. How do those ultimately impact consumers and how we spend our money?
Yeah, so you're right on with the Federal Reserve's trying to slow us down in our spending so demand slows down, so prices can cool off, really lowering inflation.
Right.
But so how are we going to affect us? Well, our credit card interest rates have gone up, mortgage rates have gone up, and now we're talking about recession. And a lot of people go back to 08. We've seen job layoffs, so there's people less motivated to spend right now because what if I don't have my job next year? What if this recession is bigger than what everyone's thinking?
Yeah.
Well, it is December 15th, which means we have 16 days left in the year. So we're kind of getting down to the end of the calendar year, too. Is there anything anybody needs to keep in mind?
Yeah, well, I think what's important, and we were talking before we went on air, that this volatility fatigue is real. I mean, the market's moved up and down 1%, double what it did last year. So everyone's exhausted by this. And so staying invested, keeping that long-term outlook, that's my wish for the end of the year for everyone.
One of the things I read last night, which was concerning, is that as a nation, our credit card debt has exploded, which you would expect because a lot of folks are making decisions between gas and food or heat. That is the most dangerous kind of debt on the micro scale, right, as households go, because the interest rate on that credit card debt is so high. So I know some people are doing it out of necessity, but the rule of thumb is if you don't have to put something on something where it's a revolving debt, you really should try to avoid that at all costs.
Oh, exactly. And if you're heading into year end with a high credit card, make that New Year's resolution for next year to stop using it and pay it off because we're not seeing interest rates come down anytime soon.
And some of those rates are in the 20s.
I know.
So it's
high.
it's almost impossible to get out of something revolving when it's that high. Elizabeth, great information. Thank you. I hope you have a great holiday season and a wonderful new year.
Thank you.